Hello and welcome to Mayor Brown's webinar on value chains and supply chains in a post-BEPS world. I'm Scott Stewart, a partner in Mayor Brown's Chicago office and a member of the tax controversy and transfer pricing practice. I represent taxpayers at all levels of federal tax controversy, including audits, administrative appeals before the Internal Revenue Service, and litigation before the United States Tax Court. Joining me today as co-presenters are partner Astrid Perron and Director of Transfer Pricing and Valuation Services, Elena Kripanova. Astrid leads the Mayor Brown European Transfer Pricing Center, which coordinates transfer pricing strategies and controversies in Europe. Her practice covers counseling on the transactional aspects of transfer pricing, tax optimization of mergers and acquisitions, structuring of investment funds, and general assistance to private equity deals. Elena, a PhD economist, has 20 years of transfer pricing, valuation, and general quantitative analysis experience. She has performed transfer pricing and valuation analyses for purposes of advanced pricing agreements, tax planning, contemporaneous documentation, audit defense, and litigation for clients that range from some of the largest multinational enterprises in the world to privately held companies in a wide range of industries. Before we begin, we'd like to mention a few housekeeping details. First, as noted under the FAQ widget on the right side of your screen, today's program is being streamed through your computer, so there is no dial-in number. For the best audio quality, please make sure your computer speakers or headset are turned on and the volume is up so you can hear the presentation. Also, please note that if you have questions for the panelists, you can pose them using the Q&A widget on the left side of the screen. With that said, let's get started. Our presentation this morning is divided into three primary sections. The first focuses on available guidance regarding value chains and supply chains in the post-BEPS environment. The second focuses on economic analysis of value and supply chains. And the third focuses on legal aspects, including relevant case law. And then we'll conclude with some final remarks.
Before we move into the matters, we would like to share a few preliminary remarks with you. In the post-BEPS environment, the concept of value is crucial. The various OECD working documents include references to value chain analysis, but without guidance. Importance is also given, notably in the transfer pricing documentation to supply chains and value drivers. With these concepts in mind, the functional analysis needs to be more granular. As we discussed in our earlier webinar, such a granular functional analysis could help taxpayers to avoid having transactions recharacterized by tax administration, and it may also help M&Es to become more efficient. This being said, the arm's length principle is still alive, but supporting and documenting it just got a little bit more complicated. Now the question is if post-BEPS, a value chain analysis is formally required, or is it a nice-to-have feature? As we will now illustrate, there is an evolution between 2013 and 2019 in the post-BEPS focus on the value and value chain analysis. In 2013, the G20 Leaders declare profits should be taxed where economic activities deriving the profit are performed and where value is created. The OECD BEPS Action Plan highlighted the change in the global economy and emphasized the importance of value chain analysis. The objective of the action plan was to restore the full effects and benefits of international standards, specifically by adapting the rules to prevent BEPS that result from the interaction among more than two countries and to fully account for global value chains. To assure that transfer pricing outcomes are in line with value creation, this is the actions 8, 9, 10, specifically by adopting transfer pricing rules or special measures to clarify the application of transfer pricing methods, in particular profit splits, in the context of global value chain, and to re-examine transfer pricing documentation, so Action 13, including transparency relating to value chain analysis. Let's look now at the 2015 final report on Action A to 10, aligning transfer pricing outcomes with value creations. Those reports have been translated in the OECD transfer pricing guidelines in July 2017. We can note the focus on understanding the value chain. The guideline indeed say it is important to understand how value is generated by the groups as a whole, the interdependencies of the functions performed by the associate enterprise with the rest of the group, and the contribution that the associate enterprises make to that value creation. We can also note the substance requirement for the supply chain. As discussed in one of our earlier webinars, a mere contractual form of the decision-making process is no longer sufficient to demonstrate the performance of decision-making functions. Therefore, in the post-BEPS environment, M&Es need to understand their value chain, including value drivers and related risks and functions. Value chain is very often associated to profit split, and indeed, the 2016 public discussion draft of revised guidance on profit splits contained a section on value chain analysis, which was dropped in the final version. The 2016 discussion of value chain emphasized the following. A value chain analysis can be used as a tool to assist in delineating the control transactions, in particular in respect of the functional analysis, and thereby determining the most appropriate transfer pricing methodology. But a value chain analysis does not of itself indicate that the transactional profit split is the most appropriate method, even where the value chain analysis shows that there are factors which contribute to the creation of value in multiple places. What is a factor for the application of that method? Since all parties to a transaction can be expected to make some contribution to value creation. The draft report also indicates that value chain analysis might usefully provide information about the following aspect of the business activity: the key value drivers in relation to the transaction, the nature of the contributions of assets, function, and risk by the associate enterprises to the key value drivers, which parties can protect and retain value through performance of the DMP functions, which parties assume economically significant risk or perform control functions, and how the economic circumstances may create opportunities to capture profits in excess of what the market would otherwise allow, such as those associated with unique intangibles, first mover advantages, or other unique contributions. In the final version of the guidance on profit split, none of the above languages was retained, likely for two reasons. Public comments to the 2016 discussion draft argue that value chain analysis was synonymous with the functional analysis. But another concern was that the focus on value chain might unduly elevate the significance of profit split, even in cases where the profit split method is not the best method. Despite direct reference, value chain analysis, or at least its components, still permeates the various OECD pronouncements. We can note the value driver frameworks underlying the functional analysis of the transfer pricing documentation, and the reference to value drivers, the supply chain, and value creation in the master file. The reference to value creation in the chapter 6 on intangibles, the focus on value in attribution of profit to PE, and the long debate on value creation in the digital economy. Let's look at the concept of value in functional analysis. The transfer pricing guidelines give importance to value creation. They indeed say it is important to understand how value is generated by the group as a whole, the interdependencies of the functions performed by the associate enterprise with the rest of the group, and the contribution that the associate enterprises make to that value creation. They also say the economically relevant characteristics or comparability factors that need to be identified in commercial or financial relations between the associate enterprise in order to accurately delineate the actual transaction include the function performed, performed, the asset use and risk assumed, including how those functions relate to the wider generation of value by the M&E group to which the parties belong, the circumstances surrounding the transaction and industry practice. We can also quote another paragraph. Determining the economic significance of risk and how risk may affect the pricing of a transaction between associate enterprise is part of the broader functional analysis of how value is created by the M&E group and the activities that allow the M&E group to sustain profits. In practice, this should be reflected in the master file. The master file indeed requires a general description of the M&E business, what include, amongst others, the identification of important drivers of business profit, a description of the supply chain for the group 5 largest product and or service offering, and the principal contributions to value creation by individual entities within the group, meaning the key functions performed, the important risk assumed, and important assets used. The importance attached to value creation is also obvious in the chapter relating to intangible. The guidelines say the functional analysis should identify all factors that contribute to value creation, which may include risk-borne, specific market characteristics, location, business strategies, and M&E group synergies, amongst others. The functional analysis should be grounded on an understanding of the M&E's global business and the manner in which intangibles are used by the M&E to add or create value across the entire supply chain. We can also note the reference to items not treated as intangible. The guidelines say that they can also contribute to the creation of value in the context of the M&E global business. In practice, this should also be reflected in the master file, which require the identification of the M&E overall strategy for the development, ownership, and exploitation of intangibles, including location of principal R&D facilities and location of R&D management, a list of intangibles or group of intangibles of the M&E group and which entities legally own them, and a list of the important agreements and intra-group agreements relating to intangibles. Regarding PEs, there is no difference between a PE and a subsidiary in this context. The additional guidance on the attribution of profit to PEs published in March 2018 applies the revised guidance contained in the report on aligning transfer pricing outcomes with value creation, so the report on BEPS Action 8 to 10. Attribution of profit should be determined as if the entity were a separate and independent enterprise. Step 1, recognition of an internal dealing between the PE and the head office. Step 2, application by analogy of the guidance contained in the transfer pricing guidelines. Value is central in the current debate around taxation of the digitalized economy. In March 2018, the OECD Task Force on the Digital Economy produced its first interim report on the tax challenges arising from digitalization. This non-consensus report provides for a discussion of the impact of digitalization and value creation. The report provides for the most extensive review of value chains of all the OECD documents so far, and it describes, next to the value chain applicable to manufacturers of goods, resellers, input suppliers, two other concepts of value creation: the value network that would be suitable for multi-site platforms, and the value shop that would be applicable to cloud computing, for example, and professional services. While members of the inclusive framework, representing 110 countries, did not converge on the conclusion to be drawn from this analysis, they committed to continue working together towards a final report in 2020, aimed at providing a consensus-based long-term solution with an update in 2019. The inclusive framework announced in January this year that there is an agreement to examine proposals involving two pillars which could form the basis for consensus. One pillar addresses addresses the broader challenge of the digitalized economy. We can note that it's not digitalization anymore, not limited to the digital economy, but it's the economy as a whole in its digital application, and focuses on the allocation of taxing rights. And the second pillar addresses remaining BEPS issues. A document for public consultation has been published on February 13, and the consultation runs till March 6. Under the first pillar, applicable to the whole of the economy, to the extent it does have digital activity, the revised profit allocation and nexus rule has as objective to recognize the value not currently recognized created by a business activity or participation in user market jurisdictions. It is composed of three proposals. The first around the value attached to user participation, the second, the value attached to marketing intangibles, and the third around the concept of significant economic presence proposal. We will see how it will develop in the coming months. This concludes the tour on the concept of value in the OECD documents, and at this stage we would conclude that if value and value creation are key concepts, there is no requirement for a formal value chain analysis. However, going forward, such an analysis could be a good risk assessment tool for MNEs, a stress test for their transfer pricing policy.
Let's now review the tools and approaches we can use to analyze value chains and supply chains. The term value driver has become ubiquitous in the business and economic literature, particularly in the last couple of years with the OECD focus on value creation, as we have just seen through the review of the various OECD pronouncements. Although we in transfer pricing prefer to work with precise definitions and exhaustive list of conditions to guide us through the analysis and structuring of the transaction, the definition of a value chain we currently have is anything but precise. The definition goes like this. A value chain is a full range of activities that firms engage in to bring a product to market. Obviously, the full range can include a plethora of functions, which means the definition is overly broad and is not at all helpful. The concept gets even more muddied when we consider characteristics of value chains. They are vertically integrated activities, which can, at the same time, be fragmented and dispersed, which means they can also be horizontally integrated with fragmented exposure to risk. In other words, a global business enterprise can be extremely difficult to analyze. If a value chain exists, then we should be able to identify its components. The research literature coined a term a value driver to reflect such individual components of a chain. But as is the case with value chains, the value driver concept is not defined consistently. The OECD states that the value driver is something that contributes to the creation of a multinational's income, but is not an asset in the accounting sense. In the academic literature, key value drivers are defined as, quote, the performance variables that will actually create the value of the business. But here's the problem. Performance variables are often associated with cost-saving measures of a supply chain rather than with a value chain. And by focusing on cost, they are more narrow in scope than the variables and indicators that we need to analyze the value chain. And then there is a further complication to the value chain analysis in the form of transfer pricing. Outside of transfer pricing, we would be content if we simply were able to identify the value drivers. Within a transfer pricing framework, it is not enough to know what processes or assets create the value. We also need to know which entities own the assets, perform the value-generating functions, bear the risk, and exercise control. In 1985, Michael Porter conceived the value chain concept as the combination of 9 value-creating activities. 5 primary activities and 4 support activities. Primary activities add value directly as the product is moving through the production process, and their contribution is typically manifested as cost advantage. Support activities are usually the source of differentiation advantage, which arises through R&D, technological innovation, information technology, and knowledge capital. Primary activities are not necessarily more important than support activities, and one could argue that over the last 30 years, support activities have gained significant prominence in value contribution. The literature provides various definitions of supply and value chains, 2 of which are quoted below. Supply chain management focuses on key cross-functional business processes to create value. Value chain is a collection of activities that are performed to design, produce, market, deliver, and support its product. While the definitions might look similar, the concepts of supply chain and value chain are not the same. Supply chain management emerged in the early 1980s as an inventory management process with the goal of streamlining the flow of inventory and optimizing capacity between operating entities within a company. As one can infer from the name, the focus in supply chains is on the costs and efficiencies of the flow of materials and products to their intended destination. The supply chain flows from supplier to customer. On the other hand, as originally envisioned in the value chain, the flow is in reverse, from the end customer to the supplier. This is because, as Porter envisioned, the customer is the source of value. In Porter's definition, value is the amount buyers are willing to pay for what a firm provides them. Therefore, value chains focus on product differentiation, product development, and marketing, whereas supply chains focus on operating efficiencies. While this demarcation is not as rigid in practice, the directional differences between supply and value chains make it easier to remember where the substantive differences in value drivers originate. The metrics and measures traditionally used for the supply chain analysis focus on 4 core processes: plan, source, make, and deliver, with particular attention to cost and operational efficiencies. We would argue that these metrics are not sufficient for a value chain analysis. This is because the core processes of the supply chain can tell us how well or poorly a particular process works, but they do not inform us on where the value is created. So how do we approach the value chain analysis? Well, we build it layer by layer. First, we need to understand the industry and company strategy to operate within that industry. We start with Porter's view. Quote, industry structure determines the industry's long-run profit potential because it determines how the economic value created by the industry is divided, how much is retained by companies in the industry versus bargained away by consumers and suppliers, limited by substitutes, or constrained by potential new entrants. These factors will determine the industry's long-term profit potential and the division of profit among the industry's participants. Therefore, once we know the industry structure, we will have the first layer of information to help us map the value drivers. We then look at the company's strategy, that is, the company's approach to navigate within the industry. Specifically, does the company want to compete on price and cost or on product differentiation? Once we know the company's strategy, we will have a second layer of information to map the value drivers. For example, a cost competitor will look to operational efficiencies and would have value drivers like procurement excellence or manufacturing efficiency. The company that competes on brand and product differentiation will derive value from brand management or product development. Note that operational efficiencies are present in both, but have a far greater significance for the cost competitor than for the brand owner. Similarly, intangible ownership, risk-bearing, and management will have a higher weight in the value chain of the company that competes on product differentiation, not on cost. Note also that the analysis of a cost competitor, because of its focus on performance measurements, is closer aligned with the supply chain than with the value chain analysis that is based on brand and product differentiation, because the value drivers are different. The direction of the analysis differs also between the cost competitor and the brand competitor. Cost advantage analysis goes from supplier to the end customer, focusing on factors that drive the cost in each activity. Value chain analysis based on brand and product differentiation is done in reverse, from end customer through production to design and R&D. At customer level, the analysis focuses on product features, marketing, and customer service. So now we have two layers in the value chain analysis, the industry layer and the company strategy to navigate within the industry. We also know the directional differences in approaching a supply chain versus a value chain analysis. But the discussion about the various layers of analysis is not very informative unless we know how to quantify the value drivers. For this purpose, the business literature has developed a couple tools to measure the effect of a process or activity. Some of these tools are better suited for the supply chain analysis, others are better for value chains. The tools for the supply chain analysis measure cost or performance variables that can be traced to sequential steps in a supply chain and to the company's income statement. Among these tools is the Supply Chain Operations Reference Model, or SCORE, which uses and quantifies 5 core business processes such as plan, source, make, deliver, and return. Activity-based measurement or activity-based costing focus on the management of activities to maximize the profit from each activity and to improve the value received by the customer by tracking cost by activity, while a collaborative planning, forecasting, and replenishment tool provides for cooperative management of inventory. Then there is a group of process analysis tools which help companies classify, catalog, and codify various processes in order to be able to obtain a better understanding of the business processes in the company. Among these tools is the Business Process Model and Notation, which is a graphical representation for specifying business processes in a business process model, and a process classification framework, which at its simplest level is a list that organizations use to define work processes comprehensively and without redundancies. A third group of tools is more suited for the value chain analysis because these tools can be used to frame questions that would directly probe the value creation process, although these tools might not be sequential, may not be easily traced to the income statement or balance sheet, and are more descriptive, fuzzy, and subjective. Among these tools are balanced scorecard, process contribution analysis, resource-based view, and combination of PCA and emerging method for causal inference called process tracing, which is based on generative causality and takes a probabilistic approach to the interpretation of evidence. None of these tools are perfect for the value chain analysis, but until we develop better tools, we have to work with what we have. As we noted, the balanced scorecard and process contribution analysis tools are better suited to perform a value chain analysis because they focus on a broader range of resources than a typical supply chain analysis by adding off-the-books intangible assets, organizational capabilities, customer and supplier relationships, and other qualitative business characteristics. Balanced Scorecard was introduced by Kaplan and Norton in the Balanced Scorecard paper published in Harvard Business Review in '92. This approach focuses on 4 basic questions. How do customers see us? Customer perspective. What must we excel at? Internal perspective. Can we continue to improve and create value? Innovation and learning perspective. And how do we look to shareholders? Financial perspective. Note that the way these questions are asked is largely qualitative, which means that the answers, which may reveal the value drivers, may not be easily quantified by reference to various cost buckets. Process contribution analysis is an approach to assess causality in program evaluations. PCA makes use of a variety of criteria, not only qualitative in nature, but also of the cost data from business processes. In this regard, there is significant overlap with the typical supply chain analysis. For example, in cases where the analysis criteria refer to time and cost of product delivery or cycle time and productivity. But even though there could be similarities in the criteria encountered across the various tools, balanced scorecard and process contribution analysis provide a more comprehensive approach to identifying value drivers relative to a supply chain analysis because they are less rigid than many of the supply chain analysis tools and can be framed to probe the value creation process. The trick is to formulate the right questions and ask them of the right people in order to solicit the most informed responses. But even in those cases, it is extremely difficult to identify and quantify the various value drivers because some value drivers often have no direct impact on revenue and profit, but instead affect the outcome through chains of cause and effect relationships. And the value created by individual intangible assets is neither linear nor additive, which means that in certain cases, it would not be as simple as to just identify a list of, say, 5 or 10 value drivers and calculate their relative shares, because the results at the end might not add up. And yet, this seems to be the best tool available to us at this moment. Process contribution analysis coupled with the RACI matrix for purposes of value chain analysis received the most attention in the OECD policy documents. This approach was mentioned in the 2014 OECD profit split discussion draft and in the Joint Transfer Pricing Forum profit split method summary of replies in June of 2018. The table on this slide provides an example which is from the JTPF profit split document and is for a centralized supply chain company and local non-routine distributors. The analysis here would proceed as follows. The first step, shown in column 1, would be to identify the relevant processes that the analyst believes may contribute to value creation. This step is of utmost importance because it determines whether the analyst proceeds on the right path and requires extensive knowledge of industry and the company's business. Then, in column 2, the importance of each process will be assessed. This would be done using the RACI matrix, which, for each process contributing to a particular value driver, considers which personnel were responsible for, accountable for, consulted in making, or merely informed of relevant decisions. The information on each process is collected through the means of interviews or questions, often through Likert-type analysis, which measures the impact of each process on a scale, typically from 1 to 5 or 1 to 7, cost contribution analysis, and scenario analysis, which looks at the outcomes with or without, or before or after various processes or factors, and compares values of outcomes before or after, or with or without. These approaches would give us the process weights. Referring back to the layering of mapping of the value chain, the steps would correspond to the first 2 layers, understanding the industry structure and understanding the company's strategy. Then the transfer pricing consideration adds another layer. It is not enough here to say that a process accounts for, say, 5 or 10% of created value. We also need to analyze which of the related entities participate in that process and what their respective contributions are. We get here to columns 3 and 4. This step involves the traditional analysis of functions, assets, and risks from Chapter 1 of the guidelines, but it also calls for the analysis of the subject entity's governance structure, which explains how the value chain is controlled by the firm. Once this step is done, the rest is easy. We calculate each entity's value contribution by multiplying process contribution by entity contribution. But getting to this very step will require a lot of work. Note also that this is not necessarily a bottom-up approach using existing indicators or an approach based on peer results. Because when we have a complex value chain, even if peer results are comparable, the value drivers might not be, because market participants may be employing different approaches to compete. Also note that the example curiously states that the contribution analysis in this JTPF example was performed with a, quote, preliminary carve-out of the contribution of the IPs. So taking this statement at face value, it would appear that one of the most important value drivers is missing from this example, which yet again underscores the difficulty with the value chain analysis.
In the time that remains, we would like to look at how the value chain concept has been applied in transfer pricing litigation, particularly as part of the IRS's litigation position in the Medtronic and Coca-Cola cases. I should note at the outset that Mayer Brown was not involved in the litigation of either of these cases, and all of the information to be discussed has been derived from publicly available sources. First, let's take a look at the Medtronic case. Medtronic designs, manufactures, and sells medical devices through related entities around the world. Medtronic US is the headquarters of the worldwide cardiac and neurologic businesses of Medtronic. Medtronic US is responsible for research related to refinements to existing products and to new therapies. Medtronic's largest manufacturing facility is Medtronic Puerto Rico Operations Company, or MPROC. Puerto Rico licensed the intangible property required to manufacture medical devices from Medtronic US. In December 2010, the Commissioner issued a Notice of Deficiency to Medtronic, determining deficiencies in tax of $548 million for 2005 and $810 million for 2006. The IRS contends that Medtronic US performed all but one of the economically significant functions for Medtronic's cardiac and neuro businesses. According to the IRS, the only economically significant function that Puerto Rico performed was assembling finished products. The IRS calculated the deficiencies by applying the comparable profits method, or CPM. The CPM evaluates whether the amount charged in a controlled transaction is arm's length according to an objective measure of profitability, such as return on assets. As part of the CPM, the Commissioner used a value chain analysis. The value chain analysis segments a company's operations into functional activities, allowing qualitative assessment of each participant's economic contributions to the profits of the consolidated enterprise. The IRS contends that individual transactions cannot be viewed in isolation, but must be viewed in the context of the overall U.S. value chain, because the transactions are too fundamentally interrelated to price independently. The IRS's value chain analysis considered each party's functions, assets, and risks that were related to the cardio and neuro businesses for the U.S. market. The purpose of the IRS's analysis is to determine the arm's length returns and associated profits for Puerto Rico's operations versus Medtronic US. The IRS's view is that Puerto Rico performed only the final manufacturing steps. The IRS concluded that the CPM properly establishes the return to Medtronic US for its contributions to the U.S. cardio and neuro businesses by subtracting the profits attributable to Puerto Rico from the overall profit of the value chain. The IRS's analysis assumed that all intangibles needed to perform finished manufacturing, other than assembled workforce and process improvements, were licensed from Medtronic US. This approach treated Puerto Rico as equivalent to many other third-party medical device manufacturers. Now let's take a look at the Commissioner's value chain analysis. The IRS's value chain approach aggregates separate transactions involving tangibles, intangibles, and services. The IRS's value chain analysis consisted of 4 steps. In the first step, the IRS calculated the value chain operating profit. In the second step, the IRS applied the CPM to Medtronic US's sale of certain components to Puerto Rico for the production of devices and leads. In the third step, the IRS applied the CPM to Puerto Rico's sale of finished devices and leads to Medtronic US. In the final step, the IRS applied the CPM results to the devices and leads licenses to reach the technology royalty rate. The IRS selected Puerto Rico as the tested party because it purportedly performed less complex functions than Medtronic US and did not own intangibles that differentiated it from other manufacturers. As comparables, the IRS selected 14 companies in the medical device industry. As part of its value chain analysis, the IRS determined that Puerto Rico incurred about 10% of the value-added costs in the U.S. cardio and neuro value chains for 2005 and 2006, but earned about 60% of the operating profits in those years. The IRS concluded that there should be 50% and 59% royalties on Medtronic USN sales for 2005 and 2006, respectively. In reaching its conclusions, the IRS determined that Puerto Rico's contributions did not include non-routine intangibles that would differentiate it from other manufacturers. Now let's take a look at the role of quality in the Medtronic case. In order to place a value on the finished product manufactured by Puerto Rico, the IRS had to examine the role of quality. Medtronic stressed that quality is critical in the medical device industry and to Puerto Rico in particular. Numerous witnesses testified about the importance of quality. The IRS downplayed the role of quality. The IRS contends that quality is not the main driver of success in the medical device industry and that Puerto Rico's focus on quality was not unique. The IRS contends that Puerto Rico's role is not appreciably more significant than that of a components manufacturer, and that it is not a particularly important facility. The IRS contends that it is Medtronic's new product pipeline, successful clinical trials, and well-trained sales force that differentiate Medtronic from its competitors. Medtronic asserted that Puerto Rico's role in quality was unique. The court found that the IRS did not place enough emphasis on quality. The court determined that product quality is the foundation on which medical devices can be successful. Now let's take a look at Medtronic's pricing method. Contrary to the IRS's value chain analysis, which aggregated multiple transactions, Medtronic applied a comparable uncontrolled transaction, or CUT analysis, to determine an arm's-length royalty for intangible property licensed by Puerto Rico. Medtronic's CUT analysis was based on a third-party licensing transaction, the Pacesetter Agreement. Medtronic's expert agreed that the Pacesetter Agreement was not a perfect comparable, and Medtronic's expert made several adjustments to address comparability issues. What was the tax court's holding in Medtronic? The court held that aggregating transactions under the IRS's value chain analysis was an abuse of discretion and did not result in a reasonable determination of true taxable income because it allocated an unreasonably small percentage of profits to Puerto Rico by dismissing the importance of Puerto Rico's role in quality. The court further determined that the royalty rates proposed by Medtronic were not arm's length because, among other things, appropriate adjustments were not made to the CUT to account for variations in profit potential. The court made several adjustments to the Pacesetter royalty, including adjustments for know-how, profit potential, and scope of products. After making adjustments, the court arrived at a revised royalty rate on intercompany sales of 44% for devices and 22% for leads. In the face of a significant loss with respect to its favored value chain theory, the IRS appealed the tax court's decision to the Eighth Circuit. The Eighth Circuit has remanded the case to the tax court for, among other things, further consideration of whether the Pacesetter Agreement is an appropriate CUT. Medtronic demonstrates the potential pitfall of the IRS's value chain analysis. In Medtronic, the court fundamentally disagreed with the IRS's analysis of where value was created in the supply chain. For that reason, the court rejected the IRS's conclusions as to an arm's-length royalty as well. Now let's take a look at the Coca-Cola case. The primary issue in Coca-Cola involves the royalty to be paid to the Coca-Cola Company, the U.S. parent of the Coca-Cola Group, by 6 related foreign licensees for use of Coca-Cola's trademarks and certain other intangible property. The IRS determined an approximately 45% royalty using a CPM method based upon income earned by unrelated Coca-Cola bottlers. The IRS issued a notice of deficiency asserting deficiencies in tax of over $3 billion for the tax years 2007 through 2009. What was the taxpayer's position in Coca-Cola? Coca-Cola conducted the core aspects of its business through related foreign licensees and service companies, the so-called business units, that were operationally and financially responsible for developing their markets. The foreign licensees developed and created consumer marketing and advertising, and manufactured and sold concentrate to local bottlers, among other activities. Consumer marketing and advertising is the most important activity and the one that requires the largest financial commitment. By necessity, these critical activities occur in the local markets. The ideas and opportunities identified by the business units drove the company's research and development priorities. The magnitude of local adaptation is reflected by the fact that the company's hundreds of product lines are offered in over 3,000 formulations in various markets around the world. Vast amounts are spent locally on consumer advertising and marketing. The foreign licensees have borne substantially all of the expenses associated with their territories. The independent bottlers are essentially distributors responsible for manufacturing finished products and distributing them. What was the IRS's position in Coca-Cola? According to the IRS, the parent company was the legal owner of the company's most valuable intangible property, including trade names, trademarks, product formulas, manufacturing specifications, and the distribution network. The foreign licensees produced and sold beverage concentrates to bottlers under manufacturing and quality guidelines set by the parent company. The foreign licensees, according to the IRS, faced relatively low market and business risks related primarily to investments in plant and equipment and accounts receivable. Bottlers and foreign licensees licensed the same intangible property from the parent company. Bottlers employed substantial sales forces that ensured widespread availability of the company's products. Bottlers also worked closely with the company in developing and integrating business and marketing plans. According to the IRS, the foreign licensees earned over $11 billion in operating profits, while the parent company reported approximately $800 million in operating profits. Let's take a look at the IRS's value chain analysis in the Coca-Cola case. The IRS's adjustments to the foreign licensees' royalties apply a comparable profits method using the return on assets of unrelated bottlers as the profit level indicator. The IRS determined that the CPM using the foreign licensees as the tested party was the best method. The IRS determined that the bottlers were uncontrolled comparables for which reliable data could be found. Applying a supply chain analysis, the IRS concludes that bottlers are compelling comparables for the foreign licensees because they used the same intangible property, performed similar manufacturing functions, acquired similar local knowledge, and performed similar customization, and performed similar marketing activities and incurred similar marketing costs. The IRS concludes that return on assets is an appropriate profitability benchmark for manufacturing and distribution activities. The IRS calculated the ROA of 24 independent bottlers and compared the ROAs to the foreign licensees' ROAs. Based on the returns of the bottlers, the IRS concluded that the compensation reported by the foreign licensees exceeded the amount they would have received in arm's-length transactions. According to the IRS, the legal owner of intangible property is able to extract 100% of all projected income from the licensed intangible. The IRS concludes that the profits that the foreign licensees retained from their sales of concentrate were attributable to the parent company's intangible property. The IRS asserts that the foreign licensees were mainly manufacturing plants that produced and sold concentrate to bottlers using benchmarkable processes. According to the IRS, the parent company was principally responsible for executing brand marketing or consumer marketing. The IRS asserts that while the bottlers had their own self-created distribution intangibles, neither the bottlers nor the foreign licensees owned any interest in the valuable intangibles owned by the parent company. Under a value chain analysis, one relevant factor in determining economic substance of risk allocation is the extent to which each controlled taxpayer exercises managerial or operational control over business activities. The IRS asserts that the parent company had a great deal of control over the business activities that directly influenced the amount of income or loss realized. The IRS asserts that the foreign licensees had limited control over their own risks. The IRS asserts that the parent company maintained control over the foreign licensees' cash flows by, among other things, approving prices that bottlers paid for concentrate, setting and monitoring business targets, evaluating business and capital plans, limiting and overseeing the capital expenditures of the foreign licensees, and limiting the ability of the foreign licensees to spend money without approval by the parent company. What was Coca-Cola's response to the IRS's position? The 1994 regulations state that with adequate data, methods that determine an arm's-length price, such as the cup method or the cut method applied here, generally achieve a higher degree of comparability than the CPM. In practice, however, the IRS has frequently applied the CPM, particularly in outbound intangibles licensing cases. In such cases, the IRS typically seeks to benchmark the profitability of one related party, the tested foreign party exploiting the U.S.-owned intangibles, by portraying its functions as routine and allocating only a routine return on the tested party's current assets or costs. Because the CPM presumptively treats the remaining returns as being earned by the licensor, its application produces extreme IRS favorable results in those cases. The IRS applied a CPM to allocate only routine returns to the foreign licensees, even though they bore the greatest direct and indirect costs in developing the intangible property in their regions. The implication of the IRS's CPM is that foreign licensees are not entitled to any credit for the investment in the consumer marketing and advertising that drive the local business. Rather, the IRS's CPM reflects its theory that the legal owner of intangible property is entitled to all expected intangible returns, and the licensees deserve only routine returns for their functions. The CPM regulations require functional comparability and similarity of asset composition. According to Coke, the bottlers and foreign licensees flunk the comparability requirements of the CPM regulations because they have fundamentally different responsibilities, functions, assets, and economic profiles. According to Coke, the IRS's theory is irreconcilable with arm's-length behavior, which reflects that licensees share in the intangible-related profits generated by their exploitation of the licensor's intangibles. The foreign licensees, as the entrepreneurs in the Coca-Cola system, were primarily responsible for the company's business in the foreign geographies. As the entrepreneurs, they made and sold concentrate, developed local consumer marketing, identified and developed new formulations for existing or novel beverages for local consumers. The foreign licensees invested far more in consumer advertising than in fixed tangible assets such as property, plant, and equipment. ROA is therefore not a reliable profit level indicator, since tangible operating assets play a small role in generating operating profits for the foreign licensees and a relatively much larger role in the operating profits of the bottlers. The ROA is flawed because it fails to compensate the foreign licensees for their substantial investments in the intangible assets. According to Coke, the IRS's CPM analysis assumes that the parent company is entitled to all non-routine returns. However, there is good reason to conclude that the parent company should earn far less because the company's decentralized business model reflects a limited contribution by the parent. In Coke's view, the transfer pricing regulations have always recognized that registered ownership of intellectual property, including trademarks, is not determinative of ownership for transfer pricing purposes. The foreign licensees bore the risk and responsibility for their business operations in the markets they served, including substantially all funding of the activities in those markets and substantially all of the headquarters expenses allocable to those markets. The IRS contends that the fact that the foreign licensees paid expenses does not mean that they were entitled to most of the profits from the parent company's intangible property. Coke asserts that the foreign licensees had operational and financial responsibility for Coke's businesses in their geographies. According to Coke, the foreign licensees' ratio of intangible investments in the form of large ongoing consumer advertising to balance sheet fixed assets, such as property, plant, and equipment, was dramatically higher than that of the bottlers. The company corrects the IRS's CPM by capitalizing the foreign licensees and independent bottlers' marketing costs. The IRS in turn asserts that by portraying distribution as routine, the company minimizes the magnitude of the bottler's marketing spend and its importance. What was Coca-Cola's transfer pricing method? Coke asserts that its international business is a franchise business in which the company and its bottlers serve distinct functions in the same supply chain. As its primary transfer pricing method, Coke looks to master franchising transactions involving trademarks and other intangible property owned by McDonald's and other franchises. Coke asserts that the master franchising transactions are cuts. Master franchising is a business model in which a franchisor licenses its trademark, product formulations, and other intangible property to a third party, the master franchisee. Like the master franchisees in the uncontrolled transactions, the foreign licensees operate at a similar intermediate level between the parent company, the franchisor, and the bottlers, the sub-franchisees, in a franchise business setting and are similarly responsible for exploiting the licensed intangible property through the same core activities as the uncontrolled master franchisees. Coke asserts that application of its cut analysis yields a royalty rate of 12.3% on concentrate sales. The result of this analysis is a profit split of 29% to the franchisor and 71% to the master franchisee. Coke's expert concludes that the foreign licensees' pre-royalty intangible-related operating profit margins measured using the base of the retail sales revenues of the company's products are similar to the intangibles-related profit margins for the uncontrolled master franchising transactions that serve as cuts. Based on this analysis, Coke concludes that at arm's length, franchisors that make available intangible property to master franchisees share significant intangibles-related profits with the master franchisees. What is the IRS's response to Coca-Cola's transfer pricing position? The IRS, in turn, asserts that the functions, assets, and risks of the foreign licensees are nothing like those of master franchisees. According to the IRS, the company's residual profit split method postulates that the marketing spend by the foreign licensees creates a separate intangible owned by the foreign licensees rather than maintaining or enhancing the intellectual property for which the parent company owns all residual rights. Like Medtronic, the Coca-Cola case again demonstrates the potential pitfall of the IRS's value chain analysis. As in Medtronic, the parties in Coca-Cola fundamentally disagreed over where value was created in the supply chain. For that reason, the parties fundamentally disagreed over the amount of an arm's-length royalty as well.
So where do we currently stand with regard to the value chain analysis? As we noted, post-BEPS environment focuses extensively on value creation, which means that the analysis of value is here to stay in some shape or form. But there is no consensus on the definitions of value chains and value drivers. Several analytical tools exist to help with measurement of the process contributions, but very few go to the heart of the value creation process. Various sections of the guidelines now require attention to value drivers, including the analysis of functions, risks, and assets, and the transfer pricing documentation. But there is no explicit guidance as to what type of analysis and information will be considered necessary and sufficient. At this point, it would appear that a descriptive presentation of value chain, rather than a quantitative presentation, should be sufficient for purposes of the transfer pricing documentation. However, a more detailed internal analysis of the value chain and the value drivers can be very beneficial to the company because it would provide a risk assessment tool that would help multinationals to better understand their own business, properly align profits and value creation, ensure consistency between DEMPI functions and legal structure, and help understand the risk of PE exposure. A detailed internal analysis would also ensure that the taxpayer creates its own value chain framework rather than having the analysis imposed on the company by the various tax administrations, which, because of the lack of consensus on the approaches to the analysis, can produce a wide-ranging results. Furthermore, as Scott noted in his overview of Medtronic and Coca-Cola, even if taxpayers and tax administrations agree on the components of the value chain analysis, they can still disagree of where the value is created, which means that the development of taxpayers' own framework, which is supported by contemporaneous data and legal documents, can go a long way in mitigating future controversies.
This concludes our webinar on value chains and supply chains in a post-BEPS world. Thank you for joining us today. We hope the information shared was useful. Thank you again for your participation and have a good day.